Welcome to Fast Casual Trends TV, where we cover some of the most exciting innovations in the hottest restaurant segment in the business. In each episode, we talk with innovators and executives about how fast casual is changing the restaurant business. You're going to learn more right here on Fast Casual Trends TV. Welcome to another episode of Fast Casual Trends TV. We are here, of course, at the Technomic and National Restaurant Association's Trends and Directions Conference in Chicago at the Ritz Hotel. And, of course, Darren Tristano, the MC man on the street right here with me. Thanks for stopping in, Darren.
Thanks for having me.
Darren, okay, Technomic going 50 years. That's pretty cool. I heard that today on stage. That's amazing.
50 years.
Wow.
Yeah, it's been great. In fact, over the course of Technomic's history, we were public once.
I didn't
back
know that.
1969.
Wow.
Did an
okay.
IPO.
Interesting.
Went public and went private about a year later.
Okay.
Had a lot of changes. We've had international, we've gone outside, but the core Technomic today has always been completely focused on food service.
Right.
And really focusing on this part of the business.
Yeah, and you guys do such a great job with, of course, not only reporting on the fast casual space, but all the categories and international. Look, Darren, let's get into kind of the breakdown. Mm-hmm. First of all, let's talk about kind of the future of where the fast casual trends are moving. So you had some interesting points today on stage talking about QSR Plus. So there's always been that issue or that question in a lot of operators' mind if fast casual is taking this kind of market share, QSR still controls the corners of America. What is that next phase? Talk to me about QSR Plus. What is that?
Okay, well, I think we all know as competition increases, especially when you're a part of the industry that's getting hurt.
Yeah.
The only choice you have is to evolve. So when we look at the QSR Plus, it's really defining those brands that kind of fit between traditional fast food and fast casual.
Right.
They move more towards a slightly higher price point, but ultimately quality and experience factors very much like what you see in fast casual, with the exception that you will often see a drive-through.
Right. You had a brand in there, though, that I didn't anticipate, and that was Potbelly. Mm-hmm. So why Potbelly in that category versus being in the full-fledged fast casual sector?
Yeah, well, Potbelly's one of the more difficult brands to argue they should be quick service versus fast casual.
Right.
And ultimately, when we look at Potbelly, what we see is a good quality product that's priced more affordably.
Okay.
And realistically, the two really big factors are, do you have a drive-through, and what's your price point?
Yeah.
Everything else can go either way. Their price point tends to be a little bit north of $8. Now, when we look at the Jimmy John's, the Firehouse Subs, Jersey Mike's, they're all in the $9 to $10 range. Their sandwiches are typically priced about $1 more.
Yeah.
And as a result, it puts them into the QSR space. Now, I've had some conversations with some Potbelly people, and they said, no, that's where we want to be. We don't want to outprice ourselves.
Right.
So they would definitely fit into the QSR space, QSR Plus, but you could make arguments that many of their elements fit fast casual.
Absolutely. All right, so the space is heating up in terms of finance. We're seeing investment capital, of course, kind of the early movers before some of the IPOs breaking out recently with Shake Shack and Habit. Catterton, of course, was active in the space. Rourke's been moving around in the space a lot with acquisition. A lot of new angel investment now starting to enter the space. With IPO, angel, private equity, all these new sources of money. What do you think that's going to do to the fast casual segment? You're at $39 billion today. We look at, you guys have reported. Where does that go from here?
So I think you're going to see some change with the smaller and the middle-sized brands. Starting with the smaller brands, private investment is really looking for 10 or less units now, where it used to be you had to have 20.
Right.
Now they're kind of saying, well, they're moving kind of quick and expanding units, so we've got to catch them while they're in the early stages before other investment firms get to them.
Right.
So they're moving down. Typically, private equity is looking for hot segments, underserved, developing quickly, and trying to get in with what they would consider a winner. Now, if you're a brand within that space or a smaller brand that's looking to grow, you want to position yourselves to be in the right place for that private equity investment or potentially down the road that IPO. So what we've seen with the success of IPOs like Shake Shack, more brands are thinking, this is how I'm going to get the money, this is how I'm going to cash out. So a lot of it comes down to continued improvement in the performance of the stores through expansion, so less cannibalization, sophistication of the operations, development of the culture of the brand,
Right.
and really starting to see a strong consumer base following these brands. But getting it to a point where if somebody were to come in and make the investment, they could almost immediately leverage the existing operational structure for more units so quickly without having to come in and redesign the wheel.
Yeah, which is, I think that's where the fast casual space has been so great in terms of performing, is they've got these really unique, polished elements in place, especially in the small. I was looking at Cava. You know, we looked at them several years ago, did an episode on Fast Casual Nation, and this was 3 years ago. They had 2 stores. Now they got this great injection of capital. You know, these guys could really go into the Mediterranean space and do something pretty special, which hasn't been done yet.
Right.
Which would be kind of cool to watch. Okay, so your thoughts on IPO of Shake Shack. So stock's moving up and down. We've got, people are saying we might hit 100 before the end of the year. Any thoughts on that?
Well, I think if you're looking at it as a more traditional investor, you probably feel that it's overvalued.
Yeah.
You know, we don't typically see those types of valuations for a brand that small.
Right.
When I look at the history of what Shake Shack has done, I think that they have taken a very smart group. Danny Meyer pushed it, created an interesting concept that has evolved, that has grown, almost as if they had kind of planned it from the start.
Right.
So I think they're a great model of what you should do if you want to be an IPO when you grow up.
Right.
I think they're very likely overvalued. I think that might shake out a little bit, no pun intended. But you know, there are a lot of brands out there like Chipotle that are very, very highly valued,
Yeah.
and continue to grow and increase. So I think you have to be careful. Even though the burger segment is very mature, even though Five Guys is over 1,000 units, over $1 billion,
Right, yeah.
there's still a lot of opportunity for a good quality product at a good price point. So I think it's fast casual.
Yeah, that's absolutely. It's good news for the fast casual segment. I think we continue to see a lot of innovation here from a menu and operations standpoint. Hey, it's always great talking to you and picking your brain and learning a little bit more.
Likewise.
I appreciate you stopping in on the episode today.
Thanks for having me.
Yeah, absolutely.